On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope everyone is well. Let's look back on last week, then we'll turn our attention to the week ahead. A momentous week. We saw the first Federal Reserve rate cut of this cycle. Markets took that positively. The US S&P 500 ended the week 1.4% higher and it hit new highs during the week. So hopes of a soft landing have grown after we also saw some quite positive economic releases during the week. Weekly initial jobless claims fell to the lowest level since May. Retail sales a little better than expected. Industrial production a little better than expected. That is a combination that share markets liked. You've got falling interest rates and you have got solid economic data that tells us that the US economy is still in fairly good shape. A little bit mixed elsewhere. European shares were down 0.5%, same as the UK. Japan was up 2.8% higher. Emerging markets were also higher, 2.2% up. The Aussie market had a decent week, up 1.4%. Not so much the case on the local front. The NZX 50 here in New Zealand had its worst week in 2 years. It was down 2.8%. We did have quite a volatile trading session on Friday, and there were some big index changes that might have pushed things around a bit. So we'll see if we stabilise next week. The local market is still in positive territory, only just, but still positive for the month of September. And with 6 trading days to go, it is on track for its best quarterly gain since 2020. It's up about 6.5% so far this quarter. So it hasn't been too bad for the local market. Turning to interest rates, 2-year Treasury yields in the US little moved. The 10-year rose 9 basis points. It ended the week at 3.74. For me, that suggests that markets see better growth ahead and less risk of a recession that would lead to even bigger rate cuts later. So I think that's the market taking that proactive 50 basis point cut from the Fed positively and choosing to believe that it will put the economy on a better footing over the next little while. Here in New Zealand, the 5-year swap rate increased slightly, not by much. It increased to 3.55%, so up about 5 basis points. Still pretty close to the lowest we've seen in more than 2 years. The currency did recover some of its recent losses. We were up against the greenback, the yen and the euro, flat against the Aussie dollar and the British pound. Some of those moves, in particular the moves against the US dollar, probably more about them than us. I think it's that bigger than expected rate cut from the Fed that did see the US dollar weaken just a little bit. That's probably why we were up against them. It was more about them falling rather than us rising. Right, let's talk about some of the key releases and key events last week. Here in New Zealand, we've got some fresh dairy prices and the headline index edged marginally higher. It was up 0.8%, a pretty solid performance from most of the products, 1.5% increase in whole milk powder. Cheese was up, bit of weakness in other areas, but the headline GDT index, the headline Global Dairy Trade Index, is up a little more than 12% in 2024, and prices have rebounded back to almost 2-year highs. We had some GDP figures here in New Zealand too, gross domestic product. These were for the June 2024 quarter, a little better than expected, although they still painted a fairly bleak picture. So the economy contracted 0.2% during the quarter. That's better than expected. Markets were expecting a contraction of 0.4%. The Reserve Bank was expecting GDP to decline 0.5%. So we still went backwards, but not by as much as many were expecting. On a per capita basis, we actually saw GDP contract 0.5%. And that's really important for me because I think you need to back out some of that strong migration we've seen in recent years to get a true picture of growth, especially on an apples for apples basis. And down 0.5% isn't fantastic. That's actually the 6th quarterly contraction of the past 7 quarters. So we haven't seen GDP per capita increase. We haven't seen growth since September 2022. So we've basically been in a recession for close to 2 years. It has been a very difficult period. Worth noting that this data is already quite dated. This is the June quarter, so it covers April, May, and June. Now we're sitting here knocking on the door of October, and that is quite a while ago. So we have seen sentiment improve out there more recently with the RBNZ cutting the OCR and mortgage rates coming down. I still think we probably are in the depths of a mild recession right here and now. I think you'll see a recovery, but that is probably a 2025 story. We'll get a couple more rate cuts before the end of this year, one in October, one in November, I expect, and I think we'll end the year of the OCR being at 4.75. That's just my guess. So mortgage rates will keep coming down, but that won't have an immediate impact. I think you probably will need to wait until early next year before you see a real uplift. But anyway, that was GDP data for the June quarter. Looking overseas, and the big event last week was the Federal Reserve. The decision came out last Thursday morning here in New Zealand, and it was a really important milestone for financial markets. So the Federal Reserve cut interest rates for the first time in more than 4 years. The Fed funds rate, and they do a range, so their range was 5.25 to 5.5. So the top of that range, 5.5, that's where it's been for more than a year, and they cut it by 0.5%. So they took it from 5.5 to 5.0. There was quite a bit of volatility in response to that. Markets didn't really know what to make of it, and that's understandable because you don't often see cuts of that magnitude outside of recessions or crises. The only times that the Fed has cut rates by 0.5% or more in recent decades is during the pandemic in 2020, during the GFC back in 07, 08, around the time of the dot-com bubble in 2001, 2002, and before that you've got to go back to the early 1990s. So it doesn't happen every day. This time around, I think the reason they went bigger is because we have seen more signs of a weakening labour market, and the Fed wants to get ahead of that. They want to get ahead of any slowdown that is looming by acting swiftly and proactively. And with headline inflation having fallen to 2.5% in August, they've felt comfortable to do that. So I think if they could wind the clock back, they probably would have kicked off the easing cycle in July, but they didn't have all the information to hand at that point. Since then, they've got a few indicators that inflation has kept coming down and that the labour market has weakened more than they expected. So this is a bit of a catch-up cut. That's what I'm sort of thinking. And good on them. They should be acting proactively. That's not a bad thing. The other interesting aspect of this decision is that it wasn't unanimous. The Fed votes, right? They have 12 voting members, and it was 11-1. So Governor Michelle Bowman became the first Fed governor to dissent since 2005. It's nearly 2 decades since we've seen one of those voting members dissent against the decision. She wanted to go 25 basis points. So she was still in favour of a cut, but she just wanted to do a smaller cut. So, they weren't terribly far apart. But anyway, that was a really important turning point for markets. We saw volatility on the day. Markets were up. Then you had the press conference. Markets were down. The following day, markets recovered and performed very well. So where to next for US interest rates? Well, we did get some fresh projections from the Fed, and they suggest that the Fed funds rate will end this year at 4.5%. That's another 50 basis points lower than it currently is. So presumably that means we're going to see a 25 basis point cut at each of the 2 remaining meetings this year. And then the Fed funds rate is expected to steadily fall throughout next year, throughout 2026, settle at 2.9%, which again, that's slightly higher than previously thought. That longer run Fed funds rate is creeping up. It's not too far off 3% now. Very similar situation to what we're seeing here in New Zealand. That neutral rate, that steady state rate, is expected to be higher than we've seen in the past. So that's something really important for investors to take note of. Markets aren't on a completely different page. They also see the Fed funds rate ending up at about 3%. However, they do expect the Fed to get there much more quickly. They think sort of by this time next year, the Fed will be pretty close to those levels. So time will tell, but really important, I think, that the Fed is off the mark and that from here they will be steadily cutting interest rates. With a bit of luck, that will be a good thing for the economy, for borrowers, and for investors. The Fed wasn't the only central bank to meet last week. We had monetary policy decisions from the Bank of England and the Bank of Japan. So both of them left interest rates on hold, no change, and that was expected. Most people were expecting that. After cutting interest rates in August, the BOE left its policy rate unchanged at 5%. It did say that it needs to be careful not to cut too fast or by too much, so they are playing it safe, but they also did note that they are on a gradual path downwards. So they're moving in the same direction as the Reserve Bank, as the Fed. They're just going to be a bit more cautious about doing that. The Bank of Japan likewise left its benchmark interest rate unchanged. That was expected too. They're only at 0.25%, which is actually the highest since 2008. But remember that Japan has had negative interest rates for most of the last decade. It was only back in March this year that they moved from negative territory back into positive territory. And you will see more hikes from the Bank of Japan. So they are doing the opposite to every other central bank around the world. Everyone else has been hiking in recent years, has got to the top of the hill and is now cutting, whereas the Bank of Japan has been battling inflation that has been too low. They've been wanting to get inflation up, wanting to get growth up, and they've been trying to sort of push the economy ahead and create some inflation. They've started to do that. Their inflation has risen to about 2.8%. That's where it was in August. So it's been increasing for 4 months now. So they're in a position where they can start increasing interest rates to more normal levels. So Japan is very much the odd one out, but I think you will see more hikes from the Bank of Japan, but we didn't see it right away. That's something we might see later in the year or early next year. Right, turning to the week ahead. Well, global growth will be very much in focus this week. We'll get the flash PMIs for September. A PMI stands for Purchasing Managers Index, and these are essentially activity indicators. We get them very, very quickly. They're always very up to date. So we're getting these for September. We're still in September, so it's very timely economic data, and they do give us a good steer about what's coming. They tend to be a very up-to-date indicator. So these will be a key event on the economic calendar. The Australian measure is out at 11 o'clock on Monday. Then we'll get the PMIs for the UK, Europe, and the US that evening, so overnight on Monday. And then the Japanese one will be out on Tuesday, the following day. Back in August, they pointed to expansion in all of the major regions, which is good. You want to see expansion, you want to see growth. The pace of that activity actually improved everywhere except for China and emerging markets, which are probably getting dragged down by China. So China still is very much one of the weak points in that global economic picture. Having said that, some of the detail was a little bit less encouraging. In places like the US, you did see evidence of the economy becoming increasingly dependent on the services sector. So manufacturing still weak in a lot of places, but I'll be watching those PMIs closely on Monday and Tuesday. In the US, we've got another big inflation report due, what they call PCE inflation. That stands for Personal Consumption Expenditures. This is the Federal Reserve's preferred inflation measure. So it will be closely watched. It always comes out on a Friday, so we'll get it on Saturday, New Zealand time. Markets are expecting headline PCE to increase 0.1% for the month. The core PCE expected to be up 0.2% for the month. That would see the annual inflation rate, PCE inflation rate, at the headline level slow to 2.3%. That's down from 2.5, lowest in 3.5 years. Core PCE expected to come in at 2.7%, which would actually be up slightly. So we're in the twos, but sort of core is oscillating around those sort of mid to high twos. There was good news and bad news in the last CPI report, which is the different inflation report that you get. The headline slowed, but the core CPI actually came in a little higher than expectations. So we'll be watching that. I'll be watching that PCE inflation report in the US on Saturday when it comes out. That will be the key release in the US. We've got a central bank meeting across the Tasman. That will definitely be worth watching. The RBA meets this week, Tuesday afternoon, 4:30 p.m, as it always is. The RBA cash rate is sitting at 4.35%. That's the highest since 2011. It last increased interest rates in November 2023, so they've been there for almost a year. We've seen talk of further hikes dry up. However, markets don't see the Reserve Bank of Australia cutting rates until December at the earliest, but possibly not until early 2025. So you've got central banks in the UK, in Europe, in New Zealand, and in the US that have all started cutting interest rates, and they're all going to continue from here on at a different pace, but at least they are all coming down the other side of the hill. The RBA is still at the summit, and we don't yet know when they will start coming down. It might be late this year, it might be early next year, but the reason for that is that inflation has been a little bit more stubborn across the Tasman. The trimmed mean consumer price index, which is the part of the inflation spectrum that the RBA focuses on, has been rising at an annual rate of 3.9%. So still too high, even though it's the lowest in 2 years or so, still too high for the RBA. So they want to see a bit more, yet you actually got some really strong labour market figures out of Australia last week. Markets were expecting employment growth in August of 25,000. It came in almost double that, 47,500. So unemployment sitting at 4.2% across the Tasman, but definitely some stronger indicators there. So that also might be causing the RBA to just sit tight, because a strong labour market is good, but it does put upward pressure on wages, which puts upward pressure on inflation. So they might be just keeping an eye on things there and looking for further evidence of a softening in the labour market and some more tangible evidence of inflation coming down. So that will be an interesting one too on Tuesday afternoon. The domestic economic calendar, pretty sparse. There's not much going on at all, to be honest. We have the trade balance, we have ANZ consumer confidence, but it's a bit of a quiet week here in New Zealand. There is a little bit going on the corporate front. We've got a few AGMs and a few earnings releases. A couple of the retailers have got full year results to come out. Kathmandu on Wednesday, The Warehouse on Thursday. Will be interesting. I imagine those results will still look pretty challenged, but I'll be interested in the outlook commentaries and any sort of updated trading comments to just see if that turn in sentiment that we've seen on the back of mortgage rates coming down, whether there's any evidence of that coming through in current trading conditions. So those two will be interesting. Fonterra also got a result on Wednesday, and a few AGMs too. Pacific Edge, Arvida, Air New Zealand, Vector. So a few things to watch. On the global front, there isn't much in terms of corporate earnings releases. Micron on Wednesday, Costco and H&M both reporting on Thursday. So that's the way it is shaping up. We have 6 trading days to go until the end of the quarter, and this quarter is shaping up as a pretty good one. Like I said at the start, the local market up 6.5%. That will be the strongest quarter since late 2020. The Aussie market is up, US is up, the UK is sort of flat, Europe's flat. Japan's had a difficult quarter, but on a currency basis, things have gone our way, and emerging markets have sort of tracked sideways as well. Corporate bonds haven't gone too bad. New Zealand corporate bonds up 3.8% for the quarter. So for the most part, I think if you're awaiting your quarterly report from your wealth manager or broker, you are probably in for a fairly solid September quarter. But we've got 6 days to go, and anything can happen in financial markets. But most of those big risk events are behind us, the Federal Reserve being the big one. So we will see how the rest of the year goes into that home stretch now with 3 months to go. Another reporting season coming up internationally that will start in a few weeks' time, mid-October, sort of going into early November. And then you have the US election on November the 5th. Kamala Harris has the lead at the moment, but politics, you wouldn't want to sort of predict an outcome, would you? Very difficult to do that with accuracy, and I still suspect it will be a fairly close race. So there's lots for us to keep an eye on over the balance of the year. All right, thanks again for listening, and we will talk again soon.
For more insights, visit craigsip.com.